Jamie Court, quick one to you. Big story in the Financial Times Lex column this morning, how after Katrina, insurance companies priced in risk by significantly raising premiums to protect themselves. Seems reasonable to me. What's your take?
Well, look, we had an industry in the last 5 years make $250 million, record profits. The year of Katrina, 2005, the year after Katrina, 2006, almost in 2007. This isn't about losses. This is about losses on the financial markets. The reason the whole insurance industry, not just the property casualty insurance industry, are pumping up their premiums or trying to, is because they're taking a hit on the mortgage market, on their other investment incomes. The claims have not been driving premium increases, and that's a real reason we've got to start to look at this industry a little differently in Congress than we do right now.
All right, and I think just to make sure everyone understands, it's a significant point you're making, Jamie. Jamie is with ConsumerWatchdog.com, which is an organization that is nonprofit, nonpartisan, but focused on trying to look carefully at the insurance companies and whether what they're doing is in the best interests of consumers. So, Stephen, obviously you're representing more the insurance side of it. Yeah. It's a big allegation to make.
It is.
They're raising premiums to make up for mortgage losses.
It is. It's also untrue. The major reason why premiums went up, especially in the coastal areas, is because the cost of reinsurance went up dramatically following the Katrina, Rita, and Wilma storms.
Because who wants to insure those properties?
Well, it became clearer that the risk of loss, of especially severe and multiple hurricanes, was much larger than had been previously thought. And we're seeing a potentially similar event this year with not only Gustav, but Hannah, Ike, and others to follow. At this point in 2005, only Katrina had come through. Rita and Wilma hadn't even arrived yet.
Jamie, where's your proof?
Well, look, we got $20 billion in claims from Katrina and some of the other related storms. In 2007, well, we have 60-some-odd billion in profits. I mean, we're looking at world record profits, so it's not claims that are driving any increase in premiums. The other issue we have seen is that the insurance industry is trying to push onto the federal government, onto the flood insurance program, every claim it can. It doesn't want to pay for wind-driven damage. It's saying it's water-driven damage, which is covered by the taxpayer. So, I mean, the numbers bear it all out. Where is the financial crisis for the industry?
You know what's interesting, though? Everyone can know this.
One little fact, $500 billion in reserves is what this industry is sitting on.
But
where is the crisis?
Don't you publish, Steve, don't you publish all? In other words, if I want to know what the earnings look like, what the capital account looks like, what the investment account looks like with respect to whatever you're buying, mortgages or non-mortgages, isn't that transparent?
Absolutely.
Can anybody go in there?
Absolutely.
So, let's say in the last few years since Katrina, how much have you built up your investment portfolio to own, let's say, subprime mortgages? In other words, this charge can be rebutted factually. I want to give you a shot at it.
It's hard to know, Larry, exactly how much the subprime crisis has affected insurers. So far, it looks like relatively little. They tend to be very conservative investors. But beyond that, the point that Jamie made about record profits isn't simply true. Insurance runs through a cycle. 2006 was a peak profit year, but 2001 was a negative year. They lost money for the whole industry.
We're in 2008.
We got to get out of here.
I would say, look at the New York.
Profit's not necessarily a dirty word, though. Profit's not necessarily
We have to leave it there, gentlemen.